Now, 5 years ago, the real estate bubble started to leak. 3 years ago, the global financial economy nearly collapsed. Today, we finally get a plan to save the embattled underwater homeowners of America. Hallelujah! Pass the potato salad. We're all going to be saved. Yeah, well. You realize 23% of all existing mortgages are underwater. Plus, banks are sitting on home equity loans and second mortgages at the original values, not market values. And if you mark to market all the negative equity, then all of the big banks in America would be insolvent. The big banks are living on life support tossed their way by the government and the Federal Reserve. This is a situation that seems destined to result in another crisis. And so, today, the Obama administration announced plans to help troubled homeowners. Actually, homeowners who benefit would just be coincidental. Understand that this plan is really designed to help the banks. The Homeowner Affordable Refinance Program, or HARP, was started in 2009. It lets homeowners refinance their mortgages at lower rates. Few people have signed up for it. Many underwater borrowers, those who owe more than their homes are worth, couldn't qualify under the program. So you've got 23% of U.S. homeowners, about 11 million, underwater. That's according to CoreLogic, a real estate data group. As of August 31st, fewer than 900,000 homeowners have refinanced. And of those, just 72,000 were underwater homeowners refinancing under the HARP program. So if you're flush with equity in your house, yeah, you could still refinance. It's possible. If you're underwater, not much chance. The administration had estimated that the program would help 4 to 5 million homeowners. Part of the problem is that the loan modifications offered by the banks are usually really rotten deals for people who are underwater. They might result in lower monthly payments, but they do that by extending the term of the loan, tacking on extra years of payments, or tacking on balloon payments, plus don't forget the closing cost and the appraisal fees. And if a homeowner was more than 25% underwater, well, the banks just gave up. So guess what happened in Arizona and Nevada and California and Florida? A no-mod loan mod would just result in default anyway, so the banks, to heck with it. And of those 72,000, by the way, well, guess what? It didn't turn out so well for them either. A lot of those would redefault because the terms were so lousy. Yeah, they bought a little time, they stayed in the house a little longer. Okay, but then it's such a bad deal, let it go. It's not worth saving for the homeowner. The new program, that's going to be so much better. New program promises to cut some of the fees, increase eligibility for deeply underwater homeowners. They don't just get shined on. And it would not require all that pesky documentation. Under the plan, the risk would fall to Fannie Mae and Freddie Mac. Where have we heard this story before? It just sounds so familiar. No documentation. It all falls to Fannie and Freddie. I've heard it somewhere. Anyway, I kind of doubt that this will have much effect. HARP has been an abysmal failure. 72,000 out of 11 million. Out of that 72,000, most of the loan mods so heavily slanted in favor of the banks that more than half default anyway. The new program, well, it might help out another 20,000, maybe another 50,000. So that's good, but it's just a blip. It does nothing to solve the problem. So what is the real motivation here? If this isn't about solving the long-suffering housing problem, what's it all about? It's about doing the bankers' bidding. The big banks have been bargaining for immunity. Doesn't look like they're going to get that. But they'll settle for clear chain of title. The big banks have been facing the wrath of attorneys general from across the country. The states have ganged up against the banks. And by wrath, I mean the banks bought and paid for a whole bunch of attorneys general, and they were on the verge of getting a sweetheart deal. When, oops, they forgot to bribe the California AG. And now the whole $20 billion settlement, yeah, that's it, $20 billion, a mere slap on the wrist, the whole settlement is now about to fall apart. Not only was a potential $20 billion settlement a mere slap on the wrist, it would have purchased immunity from future prosecution. And that was the grand bargain. The bankers' crimes during the mortgage crisis have included perjury, forgery, and investor fraud. These accusations are well documented in the consent orders that the banks signed with the Treasury Department. The crimes described in the documents include lying in affidavits that were filed with state and federal courts, the filing of court documents which hadn't been notarized but which the banks falsely asserted had been, foreclosing on homes when the banks didn't have proof that it even owned the note, and failing to sufficiently oversee outside counsel and other third-party providers handling foreclosure-related services. Well, the big settlement with the state attorneys general is falling apart. So the bankers aren't going to get immunity now, but they still have a real big problem with chain of title. At the heart of the mortgage crisis, you will find MERS, the Artificial Corporation and Electronic Database that served as the engine of the bank's mortgage scheme. They used MERS, M-E-R-S, to circumvent local taxes and to avoid meeting their legal obligations to provide a clear chain of title for ownership of a mortgage. They also used it to buy, bundle, and sell mortgages at light speed. The new mortgage plan would include the idea that any refi or loan mod would provide a cleared chain of title. In other words, it would clean up the mess created by the banks and MERS without holding them accountable for their crimes. The chain of title problem hasn't gone away, and it hangs like the sword of Damocles over the entire prospect of recovery. And make no mistake, there will be no economic recovery until the negative equity problem is resolved. And the chain of title problem must be cleaned up, and that means the banks must pay the price to clean it up. We bailed out the banks because, well, they're too big to fail. But that doesn't mean that they shouldn't have to pay now. This isn't and shouldn't be just about robo-signing. Robo-signing was symptomatic of reckless and illegal lending. From MERS to securitization paperwork to no-doc loans to predatory loans, all of this was done to maximize profits and to enable a housing bubble that was hugely profitable to a limited number of financial institutions and with extraordinary collateral damage. We need some accountability for blowing up the economy. When you look at B of A and you see that its market cap is $65 billion against a book value of $220 billion, it shows that the market recognizes that B of A's assets aren't worth what B of A claims, or that B of A has huge unrecognized liabilities, or both. Writing down negative equity would start to make book and market values converge, which is where they should be. Instead of creating silly mortgage plans that will help almost no one, the government should stop playing games and deal with the real problem. Today, the Obama administration tried to float an idea to clear the chain of title and wipe out a little negative equity, and it won't work. The Federal Reserve is sitting in the wings, ready to launch QE3, which would focus the Fed's firepower on buying mortgage-backed securities to boost home purchases and refinancing, and that won't work. If we continue to see the government try to clean up the mess for the bankers, plain and simple, it won't work. And that's just the reality. By the way, if you'd like to contact me, It's easy to do. You can contact me by email, sinclair@moneyradio.com.